In this video, we are going to talk about 10 best dividend stocks for passive income. So before starting, please like this video and subscribe to this channel for our future updates. To generate passive income, investors rely on mature dividend-paying stocks with healthy balance sheets, steadily increasing dividends, and a solid market reputation. So far, 2022 has shown that stocks can be turbulent. Longer term, equities outperform bonds and cash. And low interest rates mean low yields. In any case, the Federal Reserve is ready to boost rates soon. Economic conditions are rapidly shifting as interest rates increase and inflation rises. Others, like real estate, have seen new leaders emerge. Given the changing market climate, investors should pick dividend stocks wisely. Here are 10 best dividend stocks for passive income. So let's start. Number 10. ExxonMobil Corporation. ExxonMobil is the most valuable oil firm in North America. It's also a safe bet for income investors. ExxonMobil maintained its dividend even in 2020, when oil fell to $0 per barrel. While most energy corporations cut payouts, ExxonMobil kept them. Exxon has restarted dividend increases while paying down debt and focusing on future investment prospects. Admittedly, the stock has soared in the last year. However, shares still yield 4% and are trading at around 10 times forecast earnings. That's not terrible for a blue-chip stock like this. Number 9. Suncor Energy Incorporated. Energy is once again one of the finest places to seek for dividends. With oil back above $100 per barrel, the energy sector has a lot of potential dividends. Some investors may ask if the sector has gone too far, too quickly, and is due for a correction. In this context, huge, low-cost oil producers should be safe regardless of short-term oil and gas prices. Examples include Suncor, Canada's largest energy corporation. Its crown jewels are low-cost oil sands projects in Alberta. These assets have long lifespans and provide consistent energy supply. Due to the rising oil price, Suncor has improved its dividend and balance sheet. Shares currently yield 4% and trade at less than 7 times anticipated earnings. Number 8. Wells Fargo and AMP Company. Wells Fargo's once impeccable reputation was tarnished by a series of operational issues in the late 2010s. Federal regulators fined the bank, and it fired its executives. Years later, the bank's operations have steadied and profits are rising again. Still, investors haven't forgiven the bank for its past transgressions. Wells Fargo's stock trades at a considerably lower multiple than its peers. This should change when the bank aggressively cuts costs and buys back stock. For the next 2 or 3 years, each of these variables should boost earnings. Wells Fargo's dividend is currently slightly over 2%, but it should expand quickly over the next few years as profit growth accelerates. Number 7. Citigroup Inc. Citigroup has a bad image. Sure, it's had its share of bad loans and business lines throughout the years. Since the financial crisis, the firm has shed several of its riskier operations, and its performance have improved markedly. Citigroup should be past the statute of limitations for bad management decisions. With the current sell-off, Citigroup shares are once again cheap compared to other big banks. There's no good justification for it. The company's operational indicators have improved significantly over the last 3 years, as the bank is better converting interest income into profits. Shares trade at just 7 times forecast earnings and yield 3.9%. Number 6. Whirlpool Corp. Whirlpool is a well-known manufacturer of household appliances, such as refrigerators, washers, and microwaves. Over the last 2 years, the company's sales have risen dramatically. Many homeowners decided to upgrade their appliances to the latest models while confined at home. Whirlpool stock rose dramatically at first, as traders accounted for the company's record profits in their forecasts for the future. Whirlpool stock, on the other hand, has dropped more than 25% in the last year through April 18, as experts expect a drop in sales after the housing bubble stops. That could happen, but Whirlpool stock is now just slightly higher than where it was in 2019. That doesn't make sense because the company's massive profits over the last 2 years haven't harmed its long-term prospects. In any case, the stock is trading at only 7 times expected earnings. In February, the company increased its dividend distribution by 25%, and the stock currently yields 4.1%. Number 5. Blackstone Inc. Blackstone is a significant alternative asset management in the globe. Over the years, the organization has created a thriving business by giving large-scale exposure to less common asset classes. Pension funds, for example, have long sought a method to participate in non-listed assets including real estate, private equity, venture capital, and hedge funds. Blackstone sells these products to institutional investors and earns a lot of money in the process. Because it is linked to the ups and downs of many financial markets, the business is cyclical. Investors are plainly concerned about the possibility of a downturn and the impact of increasing interest rates on the economy. Blackstone, on the other hand, should continue its upward trend in due time. In the meantime, with the stock down more than 20% from its previous high, the dividend yield has grown to 3.6%. Number 4. Pinnacle West Capital Corp. Over the last 6 months, utility stocks have risen dramatically. Power, gas, and water utilities have become popular safe haven asset sectors as investors flock to defensive companies. As a result, several of these equities' yields have fallen to less appealing levels. There is, however, one remaining low-cost utility. Pinnacle West, which owns Arizona Public Service and Bright Canyon Energy, is the company in question. Over the last year, the company has had some short-term setbacks, including rate conflicts with local regulators and analyst downgrades. These obstacles have kept Pinnacle West stock at a lower value than peers that have already reached new highs. Pinnacle West should benefit from positive demographic drivers in the long run. Utility earnings tend to follow population expansion, and thanks to its good weather and taxation levels, Arizona is one of the fastest-growing states in the country. PNW pays a dividend of 4.4%. Number 3. Banco Latinoamericano de Comercio Exterior S.A. Bladex, or Banco Latinoamericano de Comercio Exterior, is a one-of-a-kind bank. It's a commercial bank that specializes in funding short-term trade loans. Consider short-term loans for industrial, maritime, and other similar customers. The bank's headquarters are in Panama, which makes sense given that the country is a free trade zone and home to the Panama Canal. Its board of directors is made up of several Latin American central bank leaders, and the bank's main purpose is to support the free flow of commercial goods throughout the area. Bladex has been extremely steady over the years because to its short-term loans and central banking relationships. However, with most of Latin America in a downturn, recent earnings numbers were modest. However, with commodities prices now at all-time highs, Bladex's lending demand should skyrocket. Meanwhile, Bladex pays out the majority of its profits as a dividend, with a current yield of 6.7%. Number 2. Honda Motor Company Ltd. Honda, another attractive higher dividend company from Latin America, is another attractive higher dividend stock from Japan. Most investors' dividend stock watch lists probably don't include the builder of automobiles, motorbikes, all-terrain vehicles, and a variety of other machinery. Given the recent significant drop in Honda's stock price, however, shares currently yield 5.4%. The reduction can be attributed to 2 factors. Most automakers have been severely harmed by the supply chain shortfall. After one of the greatest dips in the value of the Japanese yen in decades, Japanese corporations are particularly vulnerable. The falling yen, on the other hand, provides bargain-priced possibilities for those buying Japanese equities listed on U.S. exchanges, as dollars go further when buying Japanese stocks listed on U.S. markets. Honda's supply chain issues will be resolved sooner or later. In the meantime, the company is trading at only 7 times earnings. Number 1. CubeSmart. CubeSmart, a self-storage company, is a clever method to profit on growing prices. Storage facilities are typically rented on a month-to-month basis, and operators can quickly boost prices in response to changing market conditions. Furthermore, because these enterprises often do not require a large number of employees, the impact of inflation on labor expenses is minimal. In a rising interest rate environment, real estate investment trusts, or REITs, benefit because they have a lot of debt on their balance sheets. As inflation sets in, the value of these properties rises, but the debt burden decreases. In the current market, this is a win-win situation for storage REITs like CubeSmart. Shares are currently yielding a respectable 3.2%. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.